Good afternoon, everyone. Welcome to our confidential report for April. Quite a few things have happened in the past month, but it really has been a month of consolidation. And it's obviously a month when Mr. Ramaphosa has been exerting his influence on the economy and the political situation. The most important thing he's done, of course, is to remove Mr. Tom Moyane from SARS. That has opened the door for SARS to become much more effective and efficient in the collection of government revenue. Obviously, every country has to have good collection of revenue, otherwise nothing can really be achieved. And there's been a considerable drop-off in people voluntarily going in and paying their tax as they should. There's quite a lot of opposition and resistance, but I'm sure that the new acting head of SARS, and whenever the new head is appointed, he will also get that back into line to where it used to be, and that will obviously improve things considerably. In the meantime, obviously, Mr. Moyane has left us with a little legacy, like a 1% increase in VAT, a rise in the fuel levy, and a cutback in spending at the provinces on construction and so forth. Of course, the big issue this month has been land reform once again, and I think Mr. Ramaphosa has managed to flesh that idea out quite a bit, so that now we're in a position where we understand better what he means by expropriation without compensation. In fact, he's moved away from that word expropriation and is now using the word land reform. He said openly that it's not a smash and grab. And of course, there are some smash and grab scenarios going on. The one at Kanana Park, for example, is pretty bad. And then at Leeuwenhoutbosch, where the residents, the property owners in that area, have actually taken the matter to court. My reading has indicated that during last year, 2017, Tshwane, or Pretoria as it used to be known, handled 4,400 land invasion complaints. So this is not a small problem, this is a major problem. Land invasion is really the big issue here, and not so much giving land back to people who were unfairly deprived of it by our colonial ancestors. That is a relatively small part, and I think will be relatively well handled in due course. But something has to be done about these land invasions. At the same time, Mr. Ramaphosa has very cleverly, very deftly moved the EFF and Julius Malema to the left. They've pushed them to the left and occupied the central part of their policy, of their political policy. So much so that the EFF has come out as blatantly racist. Their handling of the Nelson Mandela issue and the vote of no confidence against Trollip was obviously blatantly racist. They even admitted that he was doing a good job, but the only reason they wanted him out was because he was white. That is not, I don't think, going to help them in the election next year. So I think that Ramaphosa has managed to occupy the middle ground, the important part of their political drive. All right, let's look at the economy. In the last quarter of 2017, GDP was up by 3.1%, which is great. And what that shows me is that our budget estimates, which were included in the February budget, were way under the actuality. In fact, the growth last year came in at 1.3% rather than the 1% which was estimated. The Reserve Bank is currently estimating 1.7% for this year, 1.4% for next year, and 2% for 2020. Overseas investors are predicting growth of between 3 and 4%, and quite honestly, we think that they are right, and the local economists and the Reserve Bank are probably being far too conservative. But the conservatism of that February budget will make the next budget look very good, because if there is growth above those levels, Obviously, the tax collections will pick up. The government's debt consolidation, which is just another word for debt repayment, will improve quite dramatically, and the ratings agencies will be very pleased as a result. I think, in fact, that some of the rating agencies, like Standard & Poor's, for example, could easily upgrade us either later on this year or maybe even next year. Moody's, of course, came through with a very good reply or answer, where they not only held us at an investment grade rating, but they also improved the outlook from negative to stable. And that decision by Moody's will save us approximately 3 billion rand a year in interest. And let's hope that the other ratings agencies follow suit and take us back up to investment grade in due course. Of course, the real problem in the South African economy, and the problem that Mr. Ramaphosa needs to pay attention to, is the burgeoning civil service. The civil service has really grown way too big, and the salary bill is burdening this country. In fact, the economist Davy Root has estimated that there are now 3 million people on the government payroll. So he's in the broadest definition of the civil service, which of course includes not just the government but also the parastatals. He says we are employing 3 million people. And clearly a country this size cannot afford that. So there has to be some belt tightening and some cutting. Obviously, we also had this interest rate cut this month, which was great, another 0.25%. Most economists here in South Africa are saying that that's about the end. We won't see any further rate cuts because they say economic growth will start improving, and then the Reserve Bank will want to at least keep rates where they are, if not push them up. We disagree. We believe that the economy is only just beginning its upward trend, and that there may well be further rate cuts before the end of this year. Of course, the way to measure this, or to look at it, is with the R186, which is a government bond. So I'm just going to put that on the screen here for you. The R186. There it is. Okay. Just going to make some adjustments here to get it the way I want it. Let's go to a line chart. Where's the line chart? There it is. And I want to put 5 years data on the screen. Now you can see this big spike here. This is where Nene was fired, and you remember we had that transfer, that messy transfer to Pravin Gordhan. And then during his term in office, things steadily improved. So this is the interest rate on the R186. So it's a market-related rate. People are buying and selling this bond. And the level of interest rates here is a very good indication of how the South African economy is performing, and particularly of overseas perceptions of this country. When perceptions are negative, overseas investors require a higher rate of interest in order to attract them to our bonds, and vice versa. So a downward trend here signifies improving economic conditions and improving prospects as far as foreign investors particularly are concerned. So you can see there's where Nene came in, and then things improved quite substantially. And then of course over here we had the ANC elective conference, this little spike here. And then after that we've had what I call the Ramaphosa effect, where interest rates have been falling quite sharply to reflect the influence of Ramaphosa and the new way, or the new order that he has brought in. So the R186 is definitely, as the leading government bond, is something you need to keep an eye on. You can get this in your software just by typing R1, then it will come up. All right, and of course this chart looks very similar to the Rand. If we go to the Rand chart, I always use the Rand PM fix, the afternoon fix, for my analysis. So I'm just going to put 5 years on the screen, and here you can see I've identified the channel within which the rand is moving. And you must remember, of course, this is the rand against the US dollar. So the higher this chart goes, the weaker the rand is. The lower it goes, the stronger the rand is. So it's kind of an inverted chart. And you can see that there are very clear channel lines developing here, and that we're well within those channel lines. And the rand is trading at about 11 Rand 80 odd to the US dollar, and seems to be holding that level quite nicely. Obviously, the Ramaphosa effect, which you can see on this chart as well, where you see the rand strengthening and strengthening, and it's sort of reaching a stasis point, a point of stability now at around 11 Rand 80, below 12 Rand, and at that level, that is very good for the economy. Obviously, it's very sensitive to things like his move to get rid of Tom Moyane at SARS, also the land issue, which is probably overall a negative. And it has a major impact, the level of the rand, of course, on inflation. And it's helped us significantly to absorb the 1% increase in VAT and also the fuel levy. If we'd had a weaker rand, plus that fuel levy, the petrol price would have gone up very, very much further than it has gone up. Of course, the strong rand is tough for the mining industry, and I'll talk a little bit more about that when I get on to commodities and looking at commodities. I'd just like to deal with a few general points now, things that have come up during the month that I think are worth commenting on. The first one is that, I don't know if you know this, but the Department of Labour here in South Africa has a thing called has a division called Productivity SA. And their job is to make sure that everything is done to improve the productivity of South Africans in the workplace. The problem is that they are cash strapped. They've got no money. They normally get cash from the Unemployment Insurance Fund. But the last money they got from the UIF, they can't account for 36 million Rand of it, and the UIF is refusing to give them any more money until they do account for it. So this is quite an ironical situation, because they're supposed to be in charge of productivity, and yet clearly they themselves are not very productive. The next thing that I'd like to look at under this heading is the fact that every year grade 1 in schools in South Africa receive 1.4 million new students. 1.4 million new students enter grade 1 every year. Of those 1.4 million, about 100,000 will end up with university degrees, or at least will be able to enter university. Most of the rest of them will be virtually unemployable. They will be adding to the 6 million people that are currently unemployed in South Africa, which equates to a 27% unemployment rate. Now, Mark Wayner, who's the CEO of Redefine, has suggested that the big companies in South Africa, the big listed blue chip companies, should all employ 5% more people, whether they need them or not, simply to give these unemployed people work experience and some exposure to the economy to make them economically active. He says that that will kickstart the economy, and I think he's probably right. And the big companies can probably afford to do this. Of course, it will affect their earnings per share, and it will affect their share price. But if they all do it, it will be the same for all of them. In other words, it won't affect their comparative position. The third thing I'd like to draw your attention to under this general category is something called the SPIVA scorecard. SPIVA is spelled S-P-I-V-A. SPIVA scorecard. It is something which is produced regularly by Dow Jones Standard & Poor's internationally, and they assess quite a few different countries, Europe and Brazil and America and so forth. And what they really look at is they look at how actively managed funds, so unit trusts and such, which are actively managed, have done against their benchmark index, the index that they compete with. And they do this over 1 year, 2 years, and 5 years. So in the most recent SPIVA scorecard, which you can look up on the internet, I think I've actually even given you the website in the notes. Over 1 year, the actively managed funds, unit trusts and so on, all over in South Africa, underperformed their benchmark index by 76%. Over 2 years, they underperformed it by 85%, and over 3 years, by 86.3%. So this kind of underlines the importance of managing your own funds in the stock market. Nobody will do it as well as you will, and certainly not the unit trusts. I mean, you have to ask yourself, why pay somebody a fee in order to underperform an index, which is essentially an average? If you want to underperform an average, this you can do for yourself. You don't have to pay somebody to do that. I mean, theoretically, the chimpanzee in the Pretoria Zoo could do it better. All right, let's now move on to Wall Street, to the international markets. I'm just going to go to the S&P 500, as we usually do. Obviously, this is the benchmark index, which we use because all the markets of the world, including the JSE, tend to follow Wall Street. So it's very important to keep a close eye on what is happening in Wall Street. So here you can see the S&P 500, and I draw attention to the fact that there's a record high here at 2872, which was made on the 26th of January. So that's nearly 3 months ago. And after that, we had a correction, basically a 10% correction here. And that took us down to this support level, which I've drawn in here at 2581. The market is currently testing that support level, and I think it will probably break down through it. If it does that, then obviously it means that this correction is going to go further, last longer, and be deeper. If I put a little bit more data on the screen here, you can see here this is the last major correction that we had here, and this took the market down about 14%, and it took 5 months from that peak to this trough, over 5 months, and it ended on the 11th of February 2016, and then we had this huge run-up. Obviously, this part of the run-up here to the record high was far too steep, and some sort of correction was inevitable. You will see a very similar pattern in a lot of our blue chip shares, this downward trend line, which is very much to do with that correction. And I'll look at that in a moment in more detail when I deal with individual shares. Of course, initially, the reason for this correction was, first of all, that the market had gone up far too quickly, and some sort of correction was not only overdue, but it was healthy. The second major reason was that the American economy was just simply doing too well, and investors became afraid that the Monetary Policy Committee there, would stamp on the brakes, raise interest rates, and that would be very bad for shares. So that fear caused the market to come off initially. And then, of course, that was compounded by Mr. Trump's trade war, which he suddenly decided to raise against the Chinese. And now the Chinese are retaliating, and this is never good for the share market. Any kind of trade war is not good for the share market, so you can expect some sort of sell-off there. What is interesting is that this level of 2581 is where the market came down to the day before yesterday, exactly the same level that it was at over here on the 8th of February this year. And then it rallied off that level, showing that there is support at this level. But now I see that tonight or today, during the day, the FTSE, which is the major index in London, the Financial Times Stock Exchange Index, which follows the top 250 shares on the London Stock Exchange, at this very moment is down about 0.86%. So that leads me to believe that this index here will probably break down through the support line when Wall Street opens tonight. It's not a definite indication, but if you watch the FTSE, you can get some indication of what markets internationally are doing. And if London is down 0.86%, it's quite likely that Wall Street will also open down. It may not end up down. So, we've got a whole day's trade from about 4:30 this afternoon through till about 10:30 tonight, when we'll know how the market closes over there. All right, of course, the American economy is the thing that you need to really look at. And this is the main reason why I believe that this is definitely not a bear trend, the start of a bear trend, but rather a correction in a bull trend. Because the American economy is doing incredibly well. The unemployment rate there is now down to about 4.1%, which is a generational low. In other words, people who are 20 to 25 years old throughout their life, it has never been this low before. So it's what we call a generational low. I see there that the Atlanta Fed, which is one of the 12 Federal Reserve Bank divisions. In America, they have 12 Federal Reserve Bank divisions located all over the country. And those people it's one of the 12 that are involved in deciding interest rates in America. They're part of the Monetary Policy Committee. And they have done an analysis of the U.S. economy, and they're expecting growth in the first quarter, GDP growth in the first quarter of 5.4%, which is literally massive, because that economy is so big that if you're talking about a 5.4% growth across that enormous economy, that is huge. That is absolutely huge. It will be obviously a record in this new recovery in the American economy, and it will be very, very important for the stock market. So if that actually does turn out to be true, you can expect the stock market in America to bounce. And of course, we're just heading into the earnings season in America. You may not be aware of it, but the American companies are required to report every quarter. So they have to report quarterly. And that means that those companies are preparing accounts and starting from about 2 weeks after the end of the quarter, so that in this case would be the end of March, the 31st of March. 2 weeks after that, they start reporting. Some of them have actually already reported in this earnings season. And every quarter it's the same. So if you take the 31st of March, mark off 2 weeks, you can expect the new earnings results to start coming out. Especially important of these, of course, are those for the S&P 500 companies, those big companies which are trading on Wall Street, and of course, which are components of this index, which I have here on the screen. Now, the earnings season for this first quarter is expected to be stronger than the December quarter, the fourth quarter of last year. So we're looking for, and in the fourth quarter of last year, by the way, the average increase in earnings across the S&P 500 companies was 15%. And it was well above analysts' expectations. In other words, about 75% of S&P companies beat the estimates that they had set down before the public. So they estimated, okay, our profits will be up by this. 75% of them beat that estimate. Analysts in the first quarter of 2018 are expecting earnings to be up by 17.3%. And if the S&P 500 companies again beat analysts' estimates, you can look forward to an S&P 500 at a new record level. I'm pretty sure of that. So the whole American economy is growing at a fantastic pace. There's much higher corporate confidence. And of course, America is heading into spring right now. So that just as we are heading into winter, they are heading into spring. And everybody there is feeling good. They're feeling good. So that helps the stock market. So that's what I've got to say about the US and the S&P 500, which obviously our market will follow. Now, I'd just like to spend a little bit of time talking about commodities, and then we'll wrap up by looking at a few companies. The first and most important thing in the commodity market is Gwede Mantashe's efforts as the Minister of Mineral Resources. He decided not to scrap Zwane's third charter, and now he's going to try and review it, and in my opinion that's trying to fit a square peg into a round hole. He really should just scrap it and get rid of it and start again, but he's not going to do that. And I think the thing that he has to remember is that South Africa is an investment destination for people, mining houses, and people who want to exploit minerals, but it's by no means the only investment destination. And we should compare ourselves with what President Mnangagwa is doing in Zimbabwe. He is making his laws in Zimbabwe much more investor-friendly. And as a result, he's attracting quite a lot of investment capital. Now, that capital could have come to South Africa, but there's so much uncertainty and negativity about the mining industry in this country that we are actually losing investment opportunities. And with those, we lose, of course, jobs. I mean, if you open the doors to these big mining houses, they will come in, they will bring in billions of US dollars, and lots more people will get jobs in the mining industry. Of course, in the gold industry, things are looking pretty bad. And the strengthening of the rand, I mean, the rand is strengthened by R2.50 against the US dollar since Ramaphosa came into his position as president. That's very bad for the gold industry. The average price per kilogram of gold now is 510,000 Rand. And just to give you some ideas there, Evander gold mine, it costs them 673,000 Rand just to take a kilo of gold out of the ground. And they are going to close. They're going to close. And when they close, 1,400 people will lose their jobs. Other gold mines are also either above that cost, that income level of 510,000, or at break even. Sibanye, for example, a huge gold mining company in this country, is roughly at break even at 510,000 Rand per kilogram. So the strength of the Rand is hammering the gold industry right now. Then finally, I'd just like to talk about cobalt. Cobalt is arguably the most sought after metal in the world right now, mainly because it is the essential ingredient for modern batteries. And as we shift over from internal combustion engines to electric motor vehicles, the demand for batteries is going to skyrocket. In fact, it is estimated that by 2030 we'll need roughly 215,000 tons of cobalt per annum. Now, at the moment, the biggest producer of cobalt in the world is the Democratic Republic of Congo, which is, as you know, a politically unstable environment. Last year, they produced 80,000 tons of cobalt. So that'll give you an idea. I mean, by 2030, we're going to need 315,000, and the biggest producer in the world is producing 80,000. Of course, a big investor in the DRC is Glencore. They own a mine there called Katanga, and Katanga has the capacity to produce roughly 34,000 tons of cobalt. And when it does that, it will be the largest cobalt mine in the world. So if you want to get involved in benefiting from the shift from internal combustion engines, from petrol-driven engines to electrical engines, then you really need to look at Glencore as the share that you probably would want to be buying. Okay, let's look at a couple of companies now. I want to start off by looking at Capitec Bank, because it's quite an interesting situation that's developing over there. Capitec had fantastic results for the year to the end of February 2018. They've just produced them, and you can find them obviously if you go to the current company comment feature in your software. They are there in the SENS. If you go to the Stock Exchange News Service, you'll find it there. But they basically now have reached a point where they've got virtually 10 million clients, which means that they are now way ahead of Nedbank, and they are closing in on Standard Bank in terms of the number of customers they have. Their headline earnings per share and their dividend were both up 18%, which is a fantastic growth rate. And 41% of their revenue comes from account fees. So they're not making all their revenue from interest on debt. A lot of their money is coming from account fees now because they've got such a big client base. They're also going to use that big client base to roll out funeral policies now, and I think that will be very, very successful. But the share price has been tumbling down. As you can see here, there's a downward trend here. It's been falling every day. It'll fall further today. In my opinion, this reflects that downward trend that we've seen on the world stock market and other areas. And I think that it is part of the correction. Of course, all the banks, by the way, are coming off, but Capitec is the worst. And this is because Capitec was so high. So I wouldn't take that too seriously. In fact, I would regard this as a potential buying opportunity for Capitec. You can see down here that there's a very clear support level at about 800 Rand per share, and the shares are now trading at around 830 Rand per share. So I would certainly look at picking up some of those while they're at these low levels. As I said, their financial results, which they've just produced, were absolutely excellent. Now, last time I was here, I spoke about how you should deal with shares like Steinhoff, and it's a very interesting scenario, but one which, as a private investor, you really need to pay attention to. Steinhoff, of course, continues to fall. So if you look at the right-hand side of the chart, you can see here the share price closed yesterday at 3 Rand 35. So it's fallen further since we spoke last. We spoke last over here. It was about 4 Rand something at that stage. It's now down at 3 Rand. And I advised you at that point to put on the 65-day exponentially smooth moving average, which you can do. It's down here in the corner of your screen. If you just click on that and go down here, you'll find that exponential moving average. There it is. And just put it on and have a look and see what it does. What I find with this moving average is that when you get a very sharp fall in a blue chip share like this, you just put on a 65-day moving average, exponentially smooth moving average, and wait for the share to break up through that level. So that means that the moving average actually represents the price that you will pay for the share at some point. And right now that moving average is down at 9 Rand 76. You can see the share is down here at 3 Rand 35. But the moving average is at 9 Rand 76, and it's come down from 59 Rand. So before the fall took place, that moving average was at 59 Rand. It's now at 9 Rand 76. So it's coming down, coming down, coming down every day that Steinhoff stays at these low levels. At some point, of course, Steinhoff will sort out its situation. And at that point, one of two things will happen. It will either go into liquidation, in which case it will never cut up through the 65-day moving average, or they will sort themselves out, and you will see the share price turn and start to go up, and by that stage, you will be paying much less. As the exponential comes down, what you're going to end up paying is less and less and less. So this is the way to handle a blue chip share which has collapsed, and we'll look at some other examples of that in due course. Before we do that, though, I'd like to just look at Stariha. You may remember Stariha. It's a spin-off from Curro, so it's also in the education business. Just going to take these vertical lines off here. Now here you can see Stariha. This is since it was listed. When it was listed, it came in at 5 Rand 60 on the first day, shot up, but it's been moving sideways and even downwards since then. And this underlines what we always say to you about new listings. Be patient, watch and wait, because you need to see what the market does with that new listing before you jump in. And often you will find that you'll be able to buy the share at less than the price that it was available for at listing. That is quite a common scenario. So anyway, we believe that Stariha probably represents some quite good value, but you've got to bear in mind that it has produced no financial statements yet. So what you're looking at there is all blue sky. You're looking only at potential. You've got no history really to go on, other than the fact that it's being run, of course, by Mr. van der Merwe, and he's the guy who built Curro up into quite a large entity. So if you believe that he can do it again with Stariha, then you should be in the share. All right, I'd like to look at EOH now. EOH was arguably one of the best shares on the JSE a while back, and just want to go there to the 2-year chart. All right, I just want to show you here. This is I've put on a 120-day moving average onto EOH, mainly because it seems to be the length of moving average necessary to avoid these tops here. You see that? So you won't get whiplashed, and it's avoided that top too. So now we're down here. There was a very nice double top formation from a technical point of view. when the share couldn't penetrate this top here at about 174 Rand. And then, of course, it broke down through the moving average here, giving you a sell signal there. And as you can see, since then it's been trending down, trending down, trending down. Now we're right down here at 46 Rand a share. And the moving average is quite a long way away from that price. So again, here you find the correct moving average for the share, and then you stick with that and wait for it to break up. So again, it's a high quality share, but it's come into some bad luck, maybe bad management. And we know that Asha Bobot has resigned as the CEO. There's another guy who's taken over. So maybe that's the reason, or maybe the model is not working very well. But whatever it is, as a private investor, you just wait for that thing to cut up through the moving average, and then that will be your time to possibly consider getting in. I think also that we should perhaps look at Comair. Comair is a remarkable company. Obviously, they run a low-cost airline in South Africa. They've got a big deal with British Airways. Just going to put a bit more data on the screen here. Okay, there you can see Comair in quite a lot of detail. So they're the people who compete directly with SAA, with Mango, and with Fly Safair, and all those people who are financed by the government. And they compete very successfully. And this company has been around for 71 years, and in that entire time, they have never had a year when they made a loss. So that's got to say something about how they manage their business. The CEO of the company says the secret is that they constantly reinvest in their fleet. So fleet renewal, that's what he says. That is the key. They're in the process now of getting 8 737-8s, which are the new Boeing, and these aircraft are 14% more fuel efficient. And not only that, they can carry a bigger passenger load. So this is why Comair is constantly taking market share away from SAA, and they're always at the front line of this process. It's a very competitive industry, and they consistently make profits over a very long period of time. Okay, well, that's about all I have for you today. There's obviously an enormous amount more in the notes themselves, and I urge you to go onto the website, get the notes, and read through them more carefully. There are more companies there which I discuss, and far more information, in fact. And please feel free to relay to us by email any questions you may have, or further discussion that you want to get involved in. Thank you very much for listening to me, and of course remember that on the first Wednesday of May at roughly the same time, I will be doing the next report. So I'll talk to you again then. Thank you. Good night.